Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good weekend, everyone. Ira Epstein, and we are now on the weekend of Friday, and this is the 18th of November, 2016, and this is your financial market update. Now, via your request, this is going to be a little different than I normally do. It's going to be weekly charts only. Now, like everything else, a chart's a chart. I happen to prefer the daily charts myself, but the weekly charts tell stories. Some markets trend better than others with weekly charts as well. Remember, when you start getting in the weekly charts, you got the whole range of a week. So the risk factors become a lot different than they do on a daily chart. But for the week, the market is still very focused on what's going to happen on the energies. In the Midwest, we're looking at the first blast of cold weather coming through this weekend. They're getting snow, as you know, in parts of the East Coast. The Rockies have had some snow, so it's getting interesting. Winter's due to come, but then we're going to warm up again next week, so that'll be interesting. Also, does OPEC reach any further deal? They don't have to do anything yet, but all the news is pointing that they're at least they're trying to set the market up that something good is happening, but it's a low bar. That's the important thing. Dollar index up 10 days in a row. Since the election, it has been nonstop, and that's because of fiscal stimulus. That's because the Fed watch page on the CME group is the business closed today, 95.4% probability of a rate hike in December. So basically it's a given, and it's discounted. You see that already in the bonds and the notes. The question, are these markets too far ahead of themselves? So when we go to the weekly chart, you can see how the market has come roaring up. Last week was the week of the election. Market crashed at first, 800-point drop off the idea that Trump was going to do better than thought. Then he won, the market came down, and then came roaring back and is now 2 weeks in a row up. I want to come back to this a minute. You're back into this general resistance area where you have failed during the summer months. So this is a real important test. And as I said earlier, this is very common between right now and Christmas that you get a lot of rally in stock indices on a seasonal basis. Will it continue remains the question. You're back into the resistance areas you see here with the with the swing lines. It's not Bollinger Bands. Swing lines having a lower low and a higher high. Very common when you have a big event that takes place. You had this event, obviously, Brexit and everything going on in this time frame right through here, and you had it again. So big events throw these charts off. No ifs, ands, or buts. They trend better when you don't have these monstrous shakeups. But the concepts are the same. So the 18-week moving average, I call that the line in the sand. The market had been under it, it's come back, and now it's closed 2 weeks in a row over it. It also held very nicely the 100-week moving average. So the bias is up, but there's no trend because the swing line isn't trending. They're fighting each other. Bollinger Bands, you fell under the lower Bollinger Band to the 100-day average, found your support. The theory's the same in Bollinger Bands. You should not trade outside of the bands more than 5% of the time. Okay, I can accept that. This means if you keep rallying next week, early resistance comes in 2206, the upper Bollinger Band. And when I add the slow stochastics, you're finally in overbought territory at a 71 reading. I consider any reading over 70 to be overbought. Could we pull back and get consolidation a bit lower? Yeah, but that's only 30 points or so, so not too far away. When we move to the Dow Jones, you're up to the upper Bollinger Band, and that causes a bit of concern, okay, for the market. You're closing over it today, which you've done. You hit the lower band and then came back in 1 week. That was last week and hit the other. You've extended. Now, last week, if we take a look at the close of the band, it was also over. So this is 2 weeks in a row. Got to be a bit cautious there and understand you're overbought, a little rich in price. At any point here, you can pull back. We'll see how much continuation there is. Then we get to the NASDAQ weekly chart, which has a pattern of a higher high and a lower low. Should the market continue up, I'd look for 49.12 as resistance. I think the most likely thing that's going to happen is consolidation at this 18-week moving average of closes, and momentum has gone pretty flat in the market. On the Russell 2000, similar to the other indices, you fell down, hit the 100-week moving average. The Bollinger Band came snapping back that week, and if you take a look, let me come to that. For the week, you had closed over the upper Bollinger Band, and week 2 over it. That doesn't mean you can't go another couple of weeks. You can, but you're on borrowed time because you're getting overbought in these markets. But in order to lock in an embedded reading, always keep that in your mind. You first have to get overbought, then build it. That's the risk in these charts. Weekly charts show much larger risk than daily charts, and that's because it takes 5 days to make up one weekly chart. In the 30-year bond, this is a clear downtrend. Lower highs, lower lows, 2 weeks under the lower Bollinger Band. Getting a theme here? 2 weeks, the week of the election, follow-through week in all these markets. That's why you're extended. 2 weeks under the 100-week moving average as well with an embedded reading. This is very powerful. All it means is that rallies are still selling signals until the red line closes over 20. In the 10-year note, same thing. 2 weeks under the lower Bollinger Band, but not trending. This market rallied off the election into the 18-week moving average of closes, then fell back the same night under and closed under, and I should say for the week instead of the night, and followed through to the downside. So the bonds look more bearish than that market. We then get to the dollar index, which is bullish. Higher lows, higher highs. It is over the upper Bollinger Band. You only stay over that band 5% of the time. I count each time a bar, let's call it the week, which is a bar on the chart, as one of those percentage points. Now, can it go 7? It can, so the numbers aren't exact, but more times than not, if you do your homework, you're going to see I'm not too far off on that. And all you did is on the break off the election, you fell into the 100-day and 18-day average and came roaring back. So quite a bullish event for this market. Euro currency, quite a bearish event for this market. Lower highs, lower lows. Notice how the 100-day and the 100-week and the 18-week moving averages skimmed each other right into that week of the election. Then the market came down, and it's just got them pushing lower. You're 1 week now under, so what? You're oversold. The longer-term chart still very bearish on this. Same in the Japanese yen in terms of momentum, but oversold as can be. You've dropped rather dramatically. You're not trending. You have a higher week and then a lower week. You're under the 18-week moving average. If it should keep dropping, I think the 87.51 level is your next support zone, and from here, that's about 250 points. It's very, very doable. So you put that all together, it gives you an idea of what you got on the weekly charts, and I think that's important. Now, for the week, take advantage of this. This is a guide to technical indicators. It was put together by Futures Magazine. I've got to tell you, 25, 30 years ago, I had one of the few copies still in existence. I have everything this group has published because I'm in love with their publications. I think it's the best one out there for traders and ETFs, derivatives, the stock market. If you're a technician, and not a technician where you've got to get into all this algebra you're never going to understand. I needed in college a teacher in algebra. Does that give you an idea? To get out of college at the end, which I did. But I was never great with A's and B's and these different quadrants. Just not my thing. I can understand the way this is all put together, and that's for the average person. For the man that's a true mathematician, move on, get some other stuff. But for most of us, this is great, and it's volumes 1 and 2. So it's Gann, it's Fibonacci, it's relative strength, it's the oscillators of momentum. It's going to have the moving averages I talk about. What it doesn't talk about is my swing line, because I created it after this. But you can see right here, you can call us, you can go to our website at Carousel of Free Offers. You can click up here if you're on YouTube, and you'll get the free offer. Or under us on a number of websites, you'll see, click here for the free offers. Just click it, a form comes up. One other thing I'm asking a favor of. Do you like these weekly charts? If you do, I want to know. If you've seen them, now you don't like them, I can go back to the daily. But come Monday, I'm back to the daily from Monday through Thursday. And if you like them, then next Friday, we'll do another set of weekly reviews for you. I'm Ira Epstein. You enjoy yourself. Have a good one. And remember, take advantage of my morning webinars, because that's where the meat of what I do what I does. What I do comes in, and what I do there is I give specific buy and sell ideas. That's really the spot to be. I'm Ira. Have a great weekend. I'll see you all Monday.